Three key messages this week. The first is I'm going to cover this week's markets in review. The second message is to touch on the Bank of England inflation report and some of the key findings. And the third is to link that back to some of the assets that we hold across the board within client portfolios. Message one, week in review. So a fairly lackluster performance from financial markets this week. The impact of last week's US weaker jobs data, I think, is pushing out expectations of US interest rates going up, which is a good thing. On the flip side, we've had quite a weak quarter for earnings, and I think that's keeping investors a little bit on the sideline. So it's confirmation that the soft patch of macro data remains, and I think that's keeping investors a little bit cautious in the short term. Message two, Bank of England inflation report. So I'll park the controversy that surrounded the Brexit comments that the Bank of England made yesterday and leave that for another day. But principally from our side, there were two key messages that came through. The first is the Bank of England expects inflation to rise towards the end of this year and into next, which is somewhat contrary to current market expectations. And the second is they expect interest rates to rise later this year and into next. Again, that's quite significantly at odds with current market prices. So those two things have a bearing on how we're positioned, particularly in fixed income securities. And message three, inflation and the impact that is having in our client portfolios. So referencing the Bank of England's inflation expectations that rates should start to go up at the back end of this year and then slowly recover to the 2% target. We run a certain proportion of our client portfolios that have inflation as their sole objective. It's been a very tricky period for these clients over the last couple of years because we've had the contrasting deflationary impact of lower interest rates and lower commodity prices. And so we've had to trade off short-term deflationary pressure with this long-term expectation that rates are rising. And I think we've navigated that reasonably well. This year's been a much more positive environment because commodity prices have rallied. Gold is up 20%, oil's up 15%. So a combination of equity markets having made slight progress this year, bond markets doing very well, and commodity prices coming back into favour this year have meant that the real return mandates, the inflation-linked mandates, have actually performed pretty well this year.